The food and beverage industry in Malaysia is a thriving sector that contributes significantly to the economy and is driven by factors such as growing population, urbanization, and rising disposable income. The government has taken steps to promote the sector growth. The COVID-19 pandemic has a significant impact on the industry, leading to changes in consumer behavior, disruption in supply chain, and increased demand for food delivery and healthy food products. The industry is still recovering and adjusting to the post-pandemic world. Background of company of Ajinomoto Corporation is a Japanese food and biotechnology corporation. Here we can see the vision of Ajinomoto and the mission.
Assalamualaikum warahmatullahi wabarakatuh. My name is Wan Muhammad Safwan bin Nordin. Today I will be present about the issue and performance of Ajinomoto. If we look at the situation of COVID-19 for the food and beverage, Ajinomoto company has faced the issues of their performance, such as in 2019, the higher advertising expenses dragged Ajinomoto for quarter earning down. Net for 2020, Ajinomoto declares 49.3 cents dividend for the year 2020, post 10% rise in first quarter 2021 net profit. And lastly, for the 2021, Ajinomoto for quarter net profit since to 6-year low of 5.8 millions.
Liquidity ratio, current ratio and the quick ratio. The trend is decline for 2019 to 2021. However, the ratio is still above 1. This is indicating that the company is able to satisfy its current liability. Equity ratio. First is average collection period. We can see that 2019 and 2021, the days is 1 day difference. Next is inventory ratio. We can see that inventory ratio have decreased a little bit. For fixed asset turnover, we can see that they are decreased significantly from 5.9 to 1.1 in 2021. Next is total asset turnover. We can see that it is declined. The ratio is declined from 0.86 to 0.61%. This means that 1 ringgit of asset generate only 0.9 ringgit.
Okay, next we move to the profitability ratio. Firstly, gross profit margin. The GPM for the year 2019 is 28.50% and it is increased in the next year, which is 13.60%, but decreased in 2021, which is 29.86%. The highest GPM is in year 2020, and it means 2020 is the most efficient in generating profit. Secondly is net profit margin. The NPN for the year 2019 is 12.64% and it is increased to 12.96% in the next year, but slightly decreased in 2021, which is 10.49%. The highest NPN is in year 2020 and it means 2020 is the most efficient in generating profit. Thirdly is return on asset. Based on the table, we can see that the ROA for Ajinomoto keep decreasing year by year, which is from 11.10% to 10.75%, and lastly to 4.56%. It shows that Ajinomoto not efficient in generate income using the asset year by year. So lastly is return on equity. From the analysis, we can see that the ROE for the year 2019 is 1.25% and slightly decreased in 2020, which is 1.24%, but drastically increased to 6.11%. It is good for the company because higher ROE indicates a higher return for the shareholder. Okay, next we move to the leverage ratio. Firstly is debt ratio. From the table, we can see that debt ratio keep increasing year by year, which is from 12.74% to 14.60% and lastly to 29.58%. It shows that the company performance is in bad performance because lower ratio indicate lower financial risk. So the best debt ratio is in year 2019. Next is debt to equity ratio. Based on the analysis, we can see that the ratio keep increasing year by year, which is from 0.0254 times to 0.0272 in the next year, and lastly 0.2219 times in 2021. It indicates that Ajinomoto not doing better using its asset because more increase in the debt to equity ratio. A high percentage often indicate that the business has been active in using debt to finance its expansion.
My name is Muhammad Anis Nazmi bin Shafi'i, and I will present about the comparative analysis, which is the changes of balance sheet. According to the table above, we can see the comparative analysis of the balance sheet from 2019 to 2021. For the total asset, we can see that inconsistency changes of percentage, which is in 2019 is 109.59 and decrease in 2020, which is 108.85 and increase in 2021 to 125.34. For the total equity in 2019 is 6.45 and increase in 2020, which is 6.52 and decrease in 2021, which is 3.36. For the total liability in 2019 is 37.32 and decrease in 2020, which is 24.80 and decrease again in 2021, which is 1.53. And lastly, for the total liability and equity in 2019 is 9.59 and decrease in 2020, which is 8.85 and increase in 2021, which is 25.34. Next is the changes of income statement. Firstly is revenue. In 2019, the percentage of revenue is 2.62 and increase in 2020, which is 3.12 and decrease again in 2021, which is negative 4.02. For the raw material in 2019 is negative 0.6 and increase in 2020, which is 3.44 and increase again in 2020, which is 116.74. For the finished good, the percentage for finished good in 2019 is negative 9.31 and increase in 2020, which is 11.35 and decrease in 2021, which is negative 14.06. For the employee benefit expenses, negative 2.63 in 2019, increase in 2020, which is 12.76 and decrease in 2021, which is negative 1.63. For the depreciation, negative 23.11 increase to 4.18 and increase again into 1.94. For the other operation expenses in 2019 is negative 5.2 and increase to 9.99 in 2020 and decrease in 2021, which is 2.90. For the profit before tax in 2019 is 8.34 and decrease in 2020, which is 7 and decrease again in 2021, which is negative 21.21. For the income tax expenses in 2019 is negative 48.79 and increase to 11.29 in 2020 and decrease to negative 70.55 in 2021. For the net profit, 0.57 in 2019 and increase to 5.78 in 2020 and decrease in 2021, which is negative 22 9.31 because of the COVID.
Okay, so for the common size analysis of balance sheet, by looking at the table here, we can deduce that Ajinomoto's total assets from 2019 until 2021 has an inconsistent trend. For the current asset, Ajinomoto company's cash and cash equivalent is not in good form, which has dropped in 2020, represented only by 19.45%. We can see that Ajinomoto companies from year 2019 to 2021 are actively retaining their income rather than giving dividends to the shareholders. Other than that, we can say that the company is decreasing its share capital from 12.21% in 2019 to 8.95% in 2021 from the total equity. Okay, next, the table here presents the common size analysis from 2019 to 2021 for Ajinomoto company's income statement. As we can see in the table here, revenue is used as the basis for the income statement, and each item on the income statement is measured as a percentage of revenue. First and foremost, changes in inventories of finished goods and work in progress increased significantly from 0% in 2019 to 0.61% in 2021, and the highest percentage is in the year 2021, which is 0.61. Next, for other operating expenses, the highest percentage comes from the year 2019, which is 17.05%, and the lowest one is from the year 2020, that is 12.95%. For profit before tax in 2021 shows the lowest percentage compared to the other years, which is 13.82%, and the highest percentage is coming from the year 2020, which is 16.49%. Furthermore, the net profit for year 2019 represents 12.31%. The year 2020 shows the highest percent, which is 12.69% as compared to the other 2 years. Lastly, for the year 2021 shows a consistent form of percent for profit net of tax. Okay, the conclusion is the uptick in COVID-19 cases and the extended movement control order MCO have put a damper on economic growth in 2021, according to Ajinomoto. In a nutshell, Ajinomoto has done a lot of great work in introducing new lines of products to the consumer, even though they know that they are having a lot of competitors in the industry. This firm experienced a decline in sales and profits because of the COVID-19 pandemic and proliferation of e-commerce portals. Looking at the financial ratio, we can see that the company is having a good performance in management of the financial, and this will definitely attract more new investors, as the new potential investors really believe that Ajinomoto company will bring such a great return to them. So the top management must come out with excellent strategies to face it well and to make sure the company is always relevant to customers over the year.
Next recommendation. Firstly, we can see that the liquidity ratio is quite high even though it continuously decreases. This indicates that Ajinomoto is good in managing its short-term debt commitment in 2019, which is before COVID-19. My suggestion is to maintain or increase the liquidity ratio by swapping short-term debt for long-term debt. By taking short-term debt liability off the balance sheet, we can improve our current ratio and quick ratio and conserve some of our short-term liquidity for other beneficial use. Next, Ajinomoto activity ratio is already in good pace but needs an improvement to ensure it can generate more revenue with the resources used especially on 2020 and 2021, which is after company affected by the COVID-19. I would like to suggest that the Ajinomoto company develop a better forecasting technique. The forecasting technique is important to ensure that they can correctly forecast customer demand, which is before COVID-19 and after COVID-19 affect the company, so that they can order inventory correctly according to customer demand. Furthermore, this company leverage ratio is also in good condition, but needs an improvement in the year after COVID-19 happened or maintain the old one to ensure Ajinomoto has enough asset to cover its debt in the future. Ajinomoto debt ratio seems continuously increased from 2019 to 2021, which is after affected by the COVID-19. I would like to recommend Ajinomoto to rechecking and restructure their debt. If Ajinomoto has high interest loan, consider refinancing. Finally, the profitability ratio. Ajinomoto company made a high revenue in 2020, then 2019 and 2021. Ajinomoto managed to get an increment on their revenue in 2020, although the company affected by COVID-19. The company needs to increase sales to ensure that the profit is surplus or higher and it does not incur further losses. I would like to recommend to the company to reduce expenses, increase sales, increase production and improve effectiveness to help the company make more profit in the future.